In general, higher volatility demands higher returns to compensate investors for the additional risk they take. STRC is shown to have lower volatility than STRF, but a higher effective yield because it's a floating rate instrument. STRF, on the other hand, pays a fixed yield, so on average it should offer a higher overall return since it carries more risk and higher volatility as compared to STRC. Meanwhile, STRK has the highest volatility, but not the highest yield, as the yield shown here represents only part of its total return potential. About 33% of STRK's value is linked to MSTR equity through a convertible option, meaning investors' returns come from a mix of income and upside participation. Think of it like a waterfall of claims. When Bitcoin rises, value flows upward. Preferred holders are paid first, with residual gains accruing to common equity. When Bitcoin falls, risk flows downward. Senior tranches remain protected, while equity bears most of the volatility. Let's look at a simple example. At a Bitcoin price of roughly $103,000, Microstrategy's holdings are worth about $66 billion. If Bitcoin were to fall 80%, those assets would shrink to around $13 billion. The most senior tranche, STRC, about $2.5 billion in size, would still be covered more than 5 times, even after such a drawdown. In that extreme case, only the subordinated preferreds like STRK and STRD would begin to feel pressure, while the common equity would be largely wiped out in mark-to-market terms. However, that doesn't mean the company would be insolvent. Assuming no debt is coming due, Microstrategy's only mandatory cash payment would be about $35 million in annual interest on its outstanding debt. With roughly $13 billion in assets, even after an 80% Bitcoin drawdown, the company should easily be able to cover that amount, because the remaining obligations are preferred dividends